What if I told you there's a market where $7 trillion exchanges hands every single day, and you can access it from your laptop or phone and make money from it? I'm talking about Forex trading, of course, and by the end of this video, you're gonna understand why 95% of traders fail and why the other 5% build life-changing wealth. And I'm gonna teach you how to become the 5%. For those of you that don't know me, my name's Rob. I used to run precision markets. I've taught hundreds of traders how to trade. Many have quit their jobs and trade full-time for a living now. And overall, while I was running the community, millions of dollars of payouts have been achieved by our community. Today, I got my manual trading to a really good place, and I mainly focus on automation and not so much education, but I decided to give back and put it all on YouTube for completely free. Here's what's different about this tutorial. I'm not gonna sell you a course or promise that you'll be rich overnight. Instead, I'm gonna give you the exact blueprint that took me 5 years and over $50,000 in losses to figure out. Also, I put together a full free YouTube course on this channel for everyone to enjoy. I'll link it in the description for you guys, but don't start the course until you finish this video. You'll understand why soon. Today, you'll understand 3 critical mistakes that destroy accounts, and a psychology trick that I'm gonna teach you that separates winners from losers. I'll also provide a live trade example of a trade I actually took on XAU USD so that you can see how the pieces of this video all fit together. This could be the most important 30 minutes of your financial education. Let's dive in. First things first, what is Forex and why should you care? Forex stands for foreign exchange. It's where the value of the world's currencies are traded against each other. Think of it like this. Instead of buying shares in companies like Apple or Nvidia, you're trading the economic growth of entire countries. The Forex market is absolutely massive. $7 trillion every single day goes through the Forex market. That's more than all the stock markets in the world combined. To put that into perspective, that's like trading Germany's entire GDP every single day. Yes, you heard that correct. Germany's entire yearly cash flow for the country gets traded every single day in the Forex market. But here's what makes Forex special and why smart money loves it. First, it's open 24 hours a day, 5 days a week. There's no waiting for the market to open. You can trade it from Sunday night to Friday night every week. Second, you can profit from it whether the price is going up or down. Try doing that with your stock portfolio when the market's crashing. Third, you can start with as little as $100 and control positions worth thousands with something called leverage. Now, leverage is a double-edged sword, and we'll touch on that later. Now, you might be wondering, how do you actually trade currencies? You don't have to walk into a bank and buy euros with US dollars. You trade what we call currency pairs. And understanding these pairs is crucial to your success. A currency pair shows the value of one currency against the other currency. Let's break down Euro USD, the world's most traded pair. Euro is the base currency, USD is the quote currency. If Euro USD is quoted at 1.085, what it actually means is $1 costs $1.08 American. Here's where it gets interesting. Currency pairs, they come in 3 different categories. We have the major pairs. These are the heavyweight champions. They include the world's strongest currencies, and they always include the US dollar. Euro USD, GBP USD, USD JPY. These are liquid, they're predictable, and they're great for beginners. Next, we have the minor pairs. These pair major currencies without the US dollar. So stuff like Euro GBP, AUD CAD. They move more slowly, but can still offer great opportunities. And then you have the exotic pairs, and this is where things get wild. These pair major currencies with emerging markets. Things like USD TRY, which is the US dollar against the Turkish lira, or Euro ZAR, which is the euro against the African rand. They're volatile, they're unpredictable, and they can destroy your account in a matter of minutes. Well, my advice, stick to the major currencies until you've proven you can be profitable. Master Euro USD or GBP USD before you even think about touching any other pairs. So how do you actually make money from the Forex market? There's There's 4 ways. Most people only know about 2. First way is going long. If you think Euro USD is going to go up and you buy at 1.08 and it goes to 1.09, you've made money. Second way is short, and that's selling. So price is at 1.08 on Euro USD. Price goes down to 1.07, you've made money. This is where the Forex market beats the stock market. You can make money whether price is going down or up. It does not matter. Third way is carry trading. That's where you profit from the interest rate differences between countries. Some currencies will actually pay you just to hold the currency overnight, and that is profiting while you sleep. Way number 4 is news trading. I don't recommend it, and there's a reason for it. Major economic announcements can move the price of a currency pair hundreds of pips in a matter of seconds or minutes. If you know how to read economic calendars, you could position yourself correctly ahead of time. Although I don't recommend this for scalping or day trading. This is more of a swing trading thing or a position trading thing where you have a very large stop that can absorb the impact of a news candle. Now there's different styles based on how long you want to hold a trade. The first is scalping, and that's in and out of trades in seconds or minutes. It's high stress and requires laser focus, but can be profitable for the very disciplined trader. Second is day trading, and that's holding positions for hours and closing everything out before bed. Good for people with a 9 to 5 that can check their positions during lunch hour. Swing trading, this is my favorite for beginners, and what I personally do, I swing trade gold, and that's holding a position for days to weeks. It's less stressful, easier to manage, and perfect if you have other commitments. And then the fourth way of doing it is position trading. You will hold positions for months or years based on economic trends. For beginners, swing trading is the sweet spot. It's profitable, it's manageable, and it won't consume your entire life. Here's where 90% of traders destroy their accounts. And it's not what you think. Most beginner traders make this fatal mistake. They only focus on technical analysis and completely ignore fundamental analysis. This is the #1 reason most traders fail. Let me explain both and why you need them working together. Technical analysis. This is reading charts, patterns, support and resistance, indicators, supply demand, stuff like that. It shows you the what and the when of the market movements. Where has price been and where might it go? Next, we have fundamental analysis. This involves understanding economic news, interest rates, central bank policies, GDP data, employment numbers, inflation, and real-world events that are currently happening, such as wars, earthquakes, stuff like that that can affect an economy. This shows you the why behind the movements, and the stronger your why, the further the move will go. Here's the truth that'll save your trading career. You need both. Technical analysis without fundamentals is like driving blindfolded. You might see a perfect setup on the charts, but an economic event's about to hit, and your perfect trade can be destroyed in a matter of seconds. Here's an example for you. You see a perfect buy on Euro USD at 8.25. The chart patterns look great, everything looks great, you enter this buy. But you don't know that at 8:30 the US is releasing unemployment data. That could spike the dollar and you'd lose money fast. I learned this lesson the hard way. I lost $3,000 because I ignored the Federal Reserve announcement. Here's how professionals actually trade. Fundamentals determine the overall direction. Should I be looking for buys or sells? Technicals determine the exact entry and exit points. Exactly where and when do I place a trade, and where do I get out? Professionals, they use fundamentals to determine their direction, and they use technicals for the exact entry and exit points. My advice to you, start with technicals because it's very easy and quick to learn, but always, always, always check your economic calendar. Fundamentals are going to take you a little bit longer to learn how entire economies of countries work, and you need to know that, but you will not learn it as quick as you can learn technicals, but you do need both. When both your fundamentals and your technicals align in the same direction, that's when you have a high probability trade. Don't be part of the 90% that fails because they ignored half the equation. Here's the uncomfortable truth about trading. Even the world's best traders lose 40 to 60% of their trades. Warren Buffett has losing years. George Soros has losing trades. Paul Tudor Jones has had some pretty large drawdowns. Success in trading isn't about being right all the time. It's about making more money when you're right and losing less money when you're wrong. This is called risk management. It's literally the difference between creating wealth and blowing accounts. Now there's 3 pillars to risk management. Pillar number 1 is position sizing. Never risk more than 1 to 2% of your account on one position. If you have a $10,000 account, never risk more than $200 on a position. This sounds boring, but it keeps you alive during losing streaks, and survival is the name of the game. Pillar 2 is a stop loss. This automatically closes your trade if price goes against you. It's like a seatbelt for trading. You hope you never need it, but you'll be glad it's there in case you crash. Pillar 3, risk-reward ratio. Always aim to make more than you risk. If you're risking $100, target $300 or more in profit. This way, you can lose 6 trades and win 4 and still make money. Here's what this looks like. You took 10 trades. 6 losses at $100 a piece is $600. 4 wins at $300 a piece is $1,200. $1,200 minus $600 means you made $600 profit. You were wrong 60% of the time, but you still made money. That is the power of risk management. All right, you want to start trading. Here's exactly what you'll need and how to avoid 95% of the traps that catch beginners. There's 3 tools you actually need. Tool number 1 is a regulated broker. I'll link mine below so you don't have to go searching if you don't know. A regulated broker is your gateway to the markets. But here's the problem. There are hundreds of brokers and many scams waiting to steal your money. Look for these non-negotiables. FCA, CFTC, ASIC. You want tight spreads on your major currencies. You want fast execution speeds and no withdrawal tricks. Avoid any broker that offers you unrealistic returns or pressures you to deposit money. Now there's one thing I want to touch on quick, and that's leverage. If you have 1 to 10 leverage, it means your $100 account can actually risk $1,000 of money. If you have 1 to 100 leverage, it means your $100 account can actually risk $10,000 worth of money. As I said before, this is a double-edged sword. For most traders, you don't need more than 1 to 30 leverage, maybe 1 to 50. More leverage usually means you'll just blow your account faster if you don't know what you're doing. You can get leverage as high as 1 to 1,000, and you do not need that to make good money. Tool number 2 is a proper trading platform. I recommend MetaTrader 4 or 5. They are the industry standard. They're proven, they're reliable, they're free. Proper regulation. Don't get distracted by fancy platforms with fancy names that have all these bells and whistles that you don't actually need. Tool number 3 is a charting software, and TradingView is the gold standard and is the best charting software that we have today. It's a clean interface, they have very powerful tools, and it's where professionals go to analyze the market. Now, when you're new, you're gonna have the demo account phase. Don't skip this step. Here's where most people mess up, and I was guilty of this myself. They deposit real money and immediately start gambling. The smart approach? Start with a demo account. This is fake money to trade in real market conditions. Spend at least 3 months proving that you can be profitable with fake money before you move on to real money. I know it's not exciting, but would you rather be bored for 3 months or broke forever? During your demo trading phase, treat every trade like it's real money. Keep a trading journal, follow your rules religiously, because if you can't be disciplined with fake money, you'll never be disciplined with real money. Here's what the gurus don't tell you. Trading is 10% strategy and 90% psychology. You can have the best system in the world, but if you can't manage your emotions, you're still gonna lose money. Now there's 4 emotions that destroy accounts. There's fear. It causes you to miss good trades, or it causes you to exit your winners early. There's greed, and it causes you to hold losers too long or risk too much on single trades. Next, we have hope. This is the most dangerous emotion. Hope keeps you in bad trades long after you should have exited. And last but not least, we have revenge. After a loss, you want to get even with the market, but the market does not care about your feelings. Let's talk about the professional trader's psychology. Professionals treat trading like a business, not a casino. They have rules and they follow them regardless of their emotions. They understand that individual trades don't matter. It's the system and the consistency over hundreds of trades that actually creates wealth. My advice for developing trader psychology: after your demo phase is over, start small. Deposit a little amount of cash into an account and start trading real money. The rule of thumb is, if losing $50 makes you emotional, you're not ready to risk $500. Keep a trading journal. Write down what you traded, how you felt, and why you made each decision. Have a trade plan you follow. If you don't know how to make one, that's fine. I've made a video on how to make a trade plan and I'll link it down below. Practice meditation or other stress management techniques, such as deep breathing. The calmer you stay under pressure, the better your decisions will be. This may not sound serious to you, but even Navy SEALs practice box breathing to stay calm and focused. It's one of the first things the US Navy teaches them because it works. All right, guys, we're gonna do a live trade example of a trade I actually took. You can see the screenshot here on your screen. Okay, so first things first, we gotta do a fundamental check. This was Sunday market open. I know there's not gonna be any news. We could check down here on my screen. You can see there's no news. TradingView identifies news with these little icons. I am pretty safe to not worry about news. The next thing I'm gonna do is I'm gonna check my fundamentals for sentiment to see what I had. Now I can tell you off memory, by hand, back then the risk sentiment was risk off. And this was fueled by Trump's tariff worries, so the market was worried and money was pouring back into gold. I mainly trade gold. Gold is a safe haven. When the market doesn't feel safe and it thinks the economy's at risk, money pours back into safe havens. So this number at the time was somewhere around the 20-30 mark, and it was a risk aversion situation. It was a risk off situation. People do not want to have risk in the market, so money leaves stocks, money pours into stuff like gold. Now, doing a quick analysis, we could see here we bounced off the daily MA, which is telling me the bullish structure is holding. We broke a high. So what we have here now is the market impulse. It's pulling back. The expectation is to impulse again. How do we confirm this? If we look here, the market sets up a liquidity cycle. It usually looks like a channel or a trend line. You have this beautiful trend line. Here it gets broken. Here our imbalance gets retested. Price reacts. Sunday market open right here breaks an internal high. This is my confirmation that the buy bias is going. I can enter a buy anywhere in here. Now, if I remember right, the first position was on this bullish candle. I don't need to cover much below my gap, because if price comes below the gap, I'm gonna probably have to reanalyze and see if I still believe in this bias. So the initial entry was meant to take out the daily high. You can see the risk reward ratio is 4.26. Anything over 2 is good, over 3 is better, but 2 or more, I'll enter a trade. 3 is ideal. So if I believe in price doing what I think it's gonna do, what I'm gonna do is I'm gonna stack risk. So this here broke out. So what I would do in this scenario is on this internal break here, I would actually put another position on, and this one I would put really tight down to here, and I would target the same daily high. This does 2 things for me. Because I doubled the risk, I can actually exit out of this position quicker if I want to, and I don't need to stay in the trades long. So we're going for a 540 pip target on that one, 600 pip target on the other. I have no issue with closing the trade out anywhere up here, because I'm still gonna make more money since I've added the risk. As price starts to go in my favor, I'm gonna start reducing the risk on the bottom position. So now if price hits stop loss, it's not gonna hurt me that bad. And ultimately, these ran to target pretty quick. Usually I swing trade and I have to hold for, longer than a day. This one was not the case. Price just kind of blew up. I ended up exiting somewhere around here. Now, a lot of people are like, why didn't you hold to full target? Once again, I doubled up my risk. I don't need to hold the trade as long. This was a lot of profit. The risk reward ratio was good. We did really good on these trades. There's no reason to get greedy, because when you get too greedy, you're going to start giving back profits. So that's a trade example of something I actually took and what I was thinking in the moments and how I would approach the market. So in this video, I gave you the complete foundation to Forex trading, but here's what I want you to remember most. It's a marathon, it's not a sprint. 95% of traders who start Forex trading, they quit within the first year. Not because Forex doesn't work, but because they treat it like gambling instead of actually developing skill. If you're serious about this, start with education, read books, watch educational content, and understand what you're getting into. Practice on a demo for at least 3 months. Prove that you can be consistently profitable with fake money. Next, start with real money. Risk tiny amounts until you've proven that the system works. Fourth is risk management above everything else. Protecting your capital is more important than making profits. If you found this valuable, hit that subscribe button. I post educational content every week to help you avoid mistakes that cost me 50 grand. What's your biggest question about Forex trading? Leave it in the comments below so I know what to make videos around. And I'll make sure your questions get answered in my following videos. Until next time, guys, remember, the market rewards patience, punishes greed, and always respects proper risk management. Trade safe, guys.